Pranam and welcome to the seventh session of my course Financial Accounting 101. In this session, we are going to learn more about the profit and loss account or the statement of profit and loss. Before we move ahead, please remember the session of our concepts and conventions of accounting, where we had discussed that there are two methods of accounting known as cash and accrual. And I had told you that cash basis of accounting is used mostly for small professionals or for smaller businesses. It's not used for the bigger businesses. What is used is the accrual method. So this will be very critical. So I'm just rebrushing it. What is accrual method? So accrual accounting refers to the recognition of revenues when earned, even if not received in cash, and the matching of the expenses when incurred, even if not paid in cash. So whether you have received the money or not is not important. Whether you have paid the money or not is not important. The accrual accounting rests on two guiding principles. Principle number one, revenue recognition principle, and the principle number two is the matching principle. So when will you recognize the revenue? You will record the revenue when A, it is earned, and B, it is realized or realizable. What is the matching principle of accounting? It records the expenses when they are incurred, whether or not they are paid. Neither the recognition of revenue nor the recording of expenses necessarily knows the receipt of payment of cash. This is very critical to understand. There's a small example, Suppose that you bought 100 kgs of wheat as your material. Out of which you are using only 25 kgs of wheat, and which you are able to sell also. So whatever you made from 25 kgs is now sold. Remaining 75 kgs still remains in your stock. So the 25 kgs of material that you have consumed in this year, okay, will be a part of your expenses. However, the remaining 75 kgs of material that you have not consumed in this year will remain as a part of your material in the inventory. That is the raw material inventory, which will be written in the balance sheet as well as in the profit and loss account. So this is critical. To understand this thing, there are many standards that we have to follow or the accountants have to follow. So if you have to follow AS accounting standards, then two relevant standards are AS 9 on revenue recognition and AS 19 on the leases. If you have to follow Ind AS, then there are Ind AS 18 on revenue recognition, Ind AS 115 on revenue from contracts with customers, Ind AS 17, that is lease contracts, Ind AS 104, that is insurance contracts, and also Ind AS 109 and 110, which are on financial instruments and other contractual rights or obligations. And there might be much more than this. So, recognizing revenues and expenses, there are certain guidelines. In addition to all the AS and Ind AS, there are certain general guidelines that exist regarding the revenue recognition. These guidelines dictate that revenue is generally realized or realizable and earned when all the following criteria are met. So these four criteria are over and above the AS and DS. No doubt they also cover this, but then these four criteria are required. Number one, there has to be persuasive evidence of an arrangement or agreement that exists. So it can be so document that can show this is what the purchase order maybe, or a sales order, mostly a purchase order. The delivery has occurred or service has been rendered. Now, what is the document that shows this? Is the GRN, goods receipt note. The seller's price to the buyer is agreed and fixed or determinable. मतलब ऐसा नहीं बोल सकते जो अच्छा लगे वो दे देना. You have to actually agree and fix a specific price. Receipt of payment is reasonably assured. This is very, very critical. When you are selling something to a person who already has been declared as a bankrupt, then this guideline says that you should not say it's a sale that has occurred because the probability of receipt of money is very, very low. These four criteria are most critical to meet anything to be recognized as revenue for that period. These guidelines are to prevent the abuse of accrual accounting by companies. Well, most of them, as I told you, accounting is a creative thing. Accountants use the rules, they bend the rules, they mend the rules so as to show what you want to see. Some of the abuses that might be prevented by using these four guidelines are: first, recording of revenues from payment milestones in advance. When such revenue should be recognized only when the milestone is reached. मतलब हो सकता है कि हमने बोला है आपको ये पैसा तभी मिलेगा जब आप ये इतना काम करके दो. But लोग क्या करते हैं? They might write the sale before that milestone is reached. So this will not be recognized as revenue because the contract says that. Then recording of revenues before the title and ownership of the goods is transferred to the customer. So आपने माल बना के अपनी फैक्ट्री में रख दिया ना, this is not that you say कि सेल हो गया. It's only when the goods are received and what to say, what to say, they are accepted by the customer by the way of GR, and that you said the title has been, what to say, title has been moved from the seller to the buyer. Recording of revenues before refund amounts are calculated. This is also very critical. You might, there be certain discounts that you might have to give, so you have to record it in net. So you have to record only that much of revenue that you are going to get. And recording of revenues when payment is not reasonably assured, as I told you. The fourth guideline will see to it that you are not recording a transaction as sale when it might be a donation transaction. So matlab, if you are donating it, it's not a sale, right? Paisa, matlab, say the goods will move out, but you are not going to get anything in return. And the method of revenue recognition for longer contracts are given, if you follow AS 9, then if you're following accounting standards, and AS 9 is relevant accounting standard which tells you how are you going to recognize the revenue for contracts which are there, which will be there for more than 1 year. So you have a road project, or you build a dam, or you're going to electric a plant जो एक साल से ज़्यादा चलने वाला है. In such contracts, how are you going to recognize the revenue? So there are two methods which AS9 proposes. Method number one is proportionate completion method or percentage of completion method. This method of accounting recognizes revenue in the statement of P&L proportionately with the degree of completion of each service. Here, the service completion consists of the execution of more than one act. Revenue is recognized with the completion of each such acts. And then we have method number two, that is completed service contract method. In this method of accounting, we recognize the revenues in the statement of P&L only when the rendering of service under a contract is completed or substantially completed. Matlab, suppose you are making a road for that sake. You are not going to recognize a single amount of rupee as sale unless and until you have handed over the road made, or substantially you have done all the work that is required to be done for the beginning of the road. That's what the method number two says. However, Ind AS 18 accepts only percentage of completion method as the method for recognizing revenues in case when you are having the longer term contracts. So the formula to compute GPO is what? You find out what is the revenue that you recognize in the current period minus the cost incurred in the current period. That will give you the gross profit of the current period. I have taken over an example of a company known as ABB Construction Limited, which has a contract to build a dam for rupees 400 crores. It will take 3 years starting from 2020. And the construction cost of 360 crores. So 400 crores is the value of the contract, and you are going to incur 60 crores of cost on it. So there's a profit of around 40 crores. Assume that warriors of ABC Construction, the warriors, that is the people of ABC Construction Limited, incur 50 crores in the year 2020, 180 crores in the year 2021, and rupees 126 crores in the year 2020 on the dam project. How are you going to recognize this 400 crores of revenue in each of these 3 years? You can see it over here. In the year 2020, the cost that you have incurred is 54 crores. The total estimated cost was 360 crores. So if I take this as the base, it means that out of the 60 crores, you have already incurred rupees 54 crores. So how much contract you might have completed? 15% of the contract. Now 15% of the contract is completed. Total contract size is 400 crores. So when I multiply 15% into 400 crores, what I get is 60 crores. So the top line or the revenue for the period of 2020 would be 60 crores in as per the percentage of completion method. Similarly, in the year 2021, you're going to incur a cost of 180 crores. Total cost is 60 crores. So if I do 180 divided by 360, how much contract have you completed? You have completed 50% of the contract. So over here, total revenues are 400 crores. So when I say 50% of 400 crores, what is the revenue you're going to recognize in the current period is 200 crores. Then the cost that I incurred in the last year, that is 2022, is 126 crores. Now 126 crores, out of this balance, if you see, 400 crore ka total revenue hai. So 60 plus 200, the whole minus 400 is 140 crores. So 140 crores of revenue you're going to recognize in the year 3, that is 2022. Now, ये जो 15% and 50% we arrived was very simple. Total cost incurred upon total estimated costs. It is not this simple as we do in real life. There are certain certificates required by the CE, that is chartered engineers and chartered architects, who give you itana completion of the project has been done, depending on the service they have made, and that's how you are going to put it. The gross profit recognized each period by ABB Limited is shown as below. So over here we have revenue recognized in the current period, as in this slide was 60, 200 and 140. So total revenue that we are going to recognize is 400 crores. Actual cost is 54, 180, 126. So when you do 60 sales or revenue minus 54 cost, you get 6 crores as gross profit. Similarly over here, 200 crores minus 180 crores, 2 crores is profit. So total comes to 400 crores. So this was a small, example to tell you how the profits are recognized for longer horizon contracts under the percentage of completion method. Now we had understood that there are three questions that needs to be answered. That's given over here. What do I own and what do I owe? That's the balance sheet. How much money I have made, that is given by the profit and loss account, and how much cash has came in, how much has gone out, which is shown by the by the cash flow statement. So over here we are concerned with the profit and loss account. You can see over here I have given a small format of profit and loss account. As I had done this in the earlier video also, there are three parts to the P&L account as we make it in traditional accounting. One is the trading account, the result of which is the gross profit. Other is the P&L account, the result of which is the net profit. And the last is the profit and loss appropriation account, which shows the distribution of profit that you have received after deducting all the expenses. Okay. So here you can say that trading account may, on the credit side, you can say it's by sales and by closing stock. Over here you have the opening stock, to opening stock, to purchase, to all the direct expenses. These are all those expenses that you incur so as to manufacture the goods or services that you are providing to the customers. So when you do sales plus closing stock and then minus all these things on the debit side, you get the gross profit. If credit is more than a debit, of course. If this is not the case, you will get a by gross loss will come on the credit side. Okay. So please remember that this gross profit that you see over here will be transferred to the profit and loss account. And if you remember, what is gross profit? Gross profit is the economics of business. Very, very critical. So the gross profit comes over here. You can add all the other incomes over here, interest from dividend income, interest income, rental income, jobi, which is not up, not your operating incomes will come over here in the penal account of the credit side. And all the indirect expenses like selling and distribution expenses, office and admin expenses, depreciation expenses, finance, that is the interest expenses, all these things will come on the debit side of the P&L account. Now, when you add the credit side of the P&L, and if you reduce the debit side of the P&L, what you get is the net profit. Again, credit has to be more than the debit, then only you will get a net profit, else you get a net loss. So once this net profit is calculated, the next step is to transfer that thing to the profit and loss appropriation account. So from over here, this will transfer over here. Now, then you say, ये पैसा जो बच गया था after paying everybody, even the government, after all my expenses, will be definitely going. I have to pay to the government of India as income tax, which will come over here to taxes paid, and I might be willing to pay the dividends. What are dividends? The amount that is paid back to the shareholders, which is a part of the profits that you have earned in that year. So this net profit is allocated to tax and dividend. And whatever remains is now added to the balance sheet as reserves and surplus. This will go to the reserves and surplus. Okay. So assume that your net profit is rupees 100, out of which you paid a tax of 30 rupees and you paid a dividend of say 30 rupees. So 100 minus 30 minus 30, you get 40 rupees over here. This 40 rupees will be added to the equity, other equity part, the reserves and surplus. I hope you remember we had done a small thing, about balance sheet in the earlier sessions. Now this profit and loss account is being shown to you how it looks like when you do traditional accounting in the T form. Now we also know that in the current way, accounts are represented in the vertical format, which looks like this. So this trading account that you see over here is a T form, and then you see when over here is the vertical form of it, which says that it's sales less cost of goods sold. Now this is very critical. Cost of goods sold, what is the formula of COGS? It's opening stock, add purchase less closing stock. So sales minus cost of goods sold minus all the direct expenses, you get the gross profit. From the gross profit, you reduce selling and distribution expenses and office and expenses. What you get is the operating income. Operating income, add all the other income that you did over here in the profit and loss account. Interest income, rental income, जो भी है वो. So when you add all the other income, what you get? You get the EBI, TDA, EBITDA. What is EBITDA? Earnings before interest, tax, depreciation, and amortization. From the EBITDA, you remove the depreciation part of it. You get the EBIT, that is earnings before interest and tax. From EBIT, you remove the finance expense, that is the interest expenses. What you get is the EBT, earnings before tax. From the EBT, you reduce the tax, you get the profit after tax, which is very critical for any company. Now, so this was the vertical representation of the profit and loss account. Again, please remember that accounts may all the three statements are related. Please remember this accounting equation and make a note of it in your brains. That assets that are the application is equal to the liabilities plus equity shareholders money. So my assets are equal to liabilities plus shareholders equity. Shareholders equity you get how? By adding contributed capital and the retained earnings. How do you get the retained earnings? It is retained earnings at the beginning of the year plus the net income of the current year minus the dividend for the period. So that you are removing because you have paid it. From how do you get net income for the period? It is total sales minus total expenses for the period. Please remember that I had told you, we had shared one example of depreciation, how it impacts all the statements. I am again putting up the same link of the same video on depreciation. It's a request that you see that video. It is very, very important to understand as we go ahead. Thank you for this session. I hope you might have understood a bit of P&L account. The next session, we might be, we will be doing specifically the P&L account with taking the examples of Reliance Industries Limited.